Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video I want to go over a company that I own in my portfolio that we haven't spoken about for a while. But before I do that, I just want to mention a couple of things. The first thing I want to mention is if you haven't joined us on the Patreon account, please do so. Okay, so you get, for £5 you actually get quite a lot of things, including ETF tracker, the stock watch list, you got the dividend calendar, you got the dividend trackers for US and UK and so on, and then you also have access to the Discord of basically people who are very like-minded, who are willing to share their journey and so on. So yeah, do that first. So the company that I'm going to talk about today is a company that I have not spoken about it basically for a while, and there is a reason why I haven't done that, because it's gone up a little bit since I actually started buying this company. And the company that we're talking about today is ASML. Okay, so ASML is one of those companies where it genuinely right now, if you believe the economy is going to improve and the economy is going to get better in the whatever years, especially with the technology and the way things are right now, this is the right company to own. And I genuinely do believe that, because every single basic device that we use, technology, anything, basically has some sort of a chip, and these chips are made by companies like the semiconductors, basically companies that like the Taiwan Semiconductors and Intels and all of them. And each one of these companies that I've just mentioned need these products. They need these two giant machines, the EUVs and the DUVs. Those two technologies, basically the devices, are created by ASML. And without these two, none of these companies, the semiconductor companies, will be able to actually, the foundry companies will be able to do the job that they do. And these things cost in the millions, right? So there are not that many options for these companies. So this company has more or less monopolized. They're based in Netherlands, okay? They have loads of basically types of these products, but their main thing is to provide the Intels and the Taiwan Semiconductors and so on, the machines they need in order to produce the chips that they have to produce. So for that reason, I own quite a bit of this company. And what I want to do today is I want to go over the financials and then see if this company is actually a buy. Because I know a lot of you have joined the journey in the last few months. So the journey meaning basically the YouTube channel, right? So what I want to show you is basically a little bit of details about this company in terms of the what the company does and so on, and then obviously for the fundamentals. And that's the things that we need to look at now. So the first thing I want to talk about is the company is obviously in the technology sector. Current price here has a $663. The year to date is actually up quite a bit, 21%, almost to 22%. And the 5-year basically return is about 221. So price wise, okay, you could have gained about over 220% in the last 5 years. EPS is about $15.40, a market cap of $263 billion. Okay, it has a wide economic moat, which means they have a competitive advantage. And I'll be honest with you, this company is the main, like when you talk about the moat, for example, this company has a moat, I believe, that's untouchable, because there's not that many companies out there that can do the things that this company does. Beta is slightly high, so that means basically slightly more volatile than the actual market. Okay, and PE seems very expensive. And if you believe the growth this company provides, okay, or will provide in the future, there's a reason why investors are thinking this company basically deserves a higher PE. But when you look at the 5-year average, 41 is basically where it's been the last 5 years. So 43 doesn't seem that expensive, but the forward PE is interestingly 27 only. So that tells us it might be basically discounted right now. And the overall sector right now is about 30. So I'm talking about the technology sector. So based on this, and look, based on the free price to free cash flow, this doesn't actually seem too expensive for me. But again, I understand why investors are putting a lot more money into this company and betting on the fact that it will do well in the future because of the growth expectations of this company, which we will look at in a second. The dividend side of it, which is actually quite good, this type of company pays the dividends. Okay, you get 1.5%. And the latest increase was 5%, and the 5-year growth rate was basically 33%. So that's really good, like for the last 3 years. And annually they will pay you almost, it's basically $7 for holding a share of this business. And ex-dividend is actually May the 1st. If you were to buy this company before that date, that means you will get paid. Okay. And then dividend growth streak of 13 years. So they have increased that dividend for 13 years in a row. And the payout ratio is only 4 to 1%, which is very good. The dividend safety, according to Simply Safe Dividend, is actually 82%. Okay, anything about 6 to 1%, we said, is always safe, right? And then you got free cash flow of $7.17 billion, which is enough to cover the dividends, buy back shares, and do all the amazing things they can do with, like, paying off debt and so on, increasing basically in reinvesting into the business, doing research and development and all of that stuff, right? And free cash flow here yield is actually 3%, which is basically 3% is fine. And basically what we're looking for is about just above 3%. So 3% should be fine. Now, in terms of profitability, this is where the company is actually excels. And if you can see here, 26% of profit margin, operating margins of 30%, return on equity of 67%, and total return in the last 10 years, you're looking at about 26%, which is absolutely amazing. And the return on invested capital is 42%. So the management of this business is actually doing really well for investors, because we're getting a lot of our money back. Basically, they're reinvesting into the business. They're doing a good job with the net income, the money that's left over, basically, right? And then revenue in terms of the last 5 years, a compounded annual growth of 16%, which is quite high, really. And then current ratio is above 1, which means if the company has enough money right now to pay enough assets to actually liquidate if they need to, right, to pay off, to cover the 12 months or the short-term liabilities. And looking at the valuation measures from the analysts. So this is basically what different analysts and different websites are saying. Again, this doesn't mean this is exactly what's going to happen. These guys do use a discounted cash flow models to come up with it. So they kind of use an estimation to see where are we now and where do we think, okay, the company will be in about 2 years, 3 years, 5 years, wherever, or currently, in terms of looking at the intrinsic value, if that's what they're looking for, or if they just want to price, basically want to count how much the price will go up in the next few months. So you can't really rely on this, but it kind of gives us an idea, right? So growth estimates for next year, they're expecting about 21%. Then on average, the next 5 years, we're expecting almost 30%, which is absolutely huge. And this is why investors are putting a lot of money into this company. And the fact that this is one of the reasons it has a higher PE, right? And this is the reason why I'm in this company, not just because of the dividends and the fact that it's in growth company, but the fact that they pay dividend and they can grow the business this much is absolutely amazing to me. Fair price, fair value from Simply Wall Street is actually lower than where the price is right now, which is 561, right? And so Simply Wall Street is saying it's actually 18% overvalued. According to Morningstar, it's slightly different. They're saying about 13% discounted. They expect the price to be 760. Okay, target price from TipRanks is actually 811, more or less the same as Seeking Alpha. They both kind of agree, so about 22%, and it's basically, it has about 22% upside. If you were to buy this stock right now, they say in a year time, in 12 months time, you will be up about 22%, but that's where they're expecting the price to be 811 and 816. Okay, and Seeking Alpha is actually saying is buy right now, according to them. So again, it kind of gives me an idea of where the company is right now, and I genuinely think this company is still undervalued. It's got a long way to go. But Seeking Alpha and Morningstar are good, but Morningstar is the one I normally go with, because I think, like, with their discounted cash flow models, I think they're a little bit more, they have a little bit margin of safety, if you like. Okay, so that's why I actually prefer this over other companies. But again, it is good idea to have a look at these things, and some of them actually is only 12 months, but these guys are looking for the intrinsic values of the business and so on, whereas these guys are looking price appreciation in the next 12 months. So they do use different models. ASML, in terms of RIAT compliance side of things, absolutely no issues. Interest bearing debt very, very low. This is one of the reasons I'm sick of tired of owning companies that have a high interest bearing debt. Okay, so 2% is actually perfect for me, and the more I can own this type of companies, the more I can actually forget about it. In a few years, if I don't want to look at this portfolio, I know the interest bearing debt hopefully will not increase from 2% to 30% all of a sudden, or 33%, whatever it is. Okay, But then again, it's one of those things that I want more companies. I want to own more companies that have a low, very, very, very low interest-bearing debt, and interest-bearing securities is also quite low. In terms of share buybacks, this is great. So the company, not only are they paying you some dividends, they also are buying back their own shares, which is quite nice. I like when the companies do this, especially growth companies, because some of them do issue a lot of basically shares to finance for things that they want to do, based in terms of increasing the business and so on. So, but this one is actually, there's no issues. So there you have it. This is one of the companies that I own in my portfolio, and as you can see, in fact, they are my biggest holdings right now. 6.15% of my portfolio, of £4,292 of basically of my portfolio is in this business. Right now, what is the plan going forward? I want to buy more before this company goes up again. If the market come down a little bit and maybe another 2-3, if it comes down 2-3%, that would be really nice, because I don't want to, my average is right now $604, okay, or 500 and whatever, right, £6, but yeah, so if it comes back down to, let's say, 630ish or whatever, I want to own 2 more shares of this company. That will be roughly about £1,000, give or take. So that's the plan. I'm not selling this. I'm not going to touch it. I want to leave it here. The fact that it pays me dividend, the fact that there's a growth expectations for this company, I want to leave it where it is right now. Now, talking about estimations, okay, the annual estimate summary here for the EPS, consensus EPS estimates for the next basically year. So we're looking at only the first 3, because these are where 25, 23, 20. Let me actually zoom in. You might be able to. You might not be able to see it. So 18, basically analysts are thinking about 27% growth in terms of by 2025, almost 2025 again, 32%. So basically this is what they're expecting. Again, remember, these are analysts. Sometimes they get paid to actually do these things, to increase it, blah, blah, blah. So you have to basically be careful with that, but just take it for what it's worth, right? 25% in terms of the revenue growth, 13%, 16%, 14%. Okay, again, looking at the top 3, is over basically double digits in basically growth. Again, absolute business, great business. And if things continue the way they are, especially in the US, where they're trying to diversify away from having their basically semiconductor companies products basically produced outside the US, and they want to bring everything to the US, and the fact that there is Intel's building one, Micron is building one, all of these companies are building their own basically factories in the US. This is the company that will benefit, because these are the products that they will need. Okay, and China's trying to also start this, because obviously they sell it to China as well. Apparently the US tried to block this company, but they said nope, we're gonna carry on as the things are. So yeah, this is one of the, as you can see, I'm very bullish on this company, but again, that doesn't mean you should buy it. You have to do your own research, inshallah. If you enjoy this type of videos, please like the video, subscribe to the channel, and like I said, join us on the Patreon. You get a lot of benefits for just £5 a month. Okay, you get all of this, and after the first month, if you don't like the Discord, if you whatever, then again, you've got access to your spreadsheets, and no one's going to take that away from you. And anytime I do update as well, I will be updating soon, inshallah, after Ramadan. Some of them I will be sharing that for free with the people that are already in the Discord. Inshallah, have a wonderful day. Assalamu Alaikum.